You ever get the feeling that Wall Street is speaking a completely different language? Well, you're not wrong. Because beyond the stocks and bonds we hear about all the time, there's this whole other hidden world. It's a world of super complex tools designed to slice dice and reshape financial risk in ways that can seem honestly like magic or, on the flip side, incredibly dangerous. Today, we're going to pull back that curtain.
Yeah, that's the big question, right? And that's exactly what we're digging into. We are going to demystify some of the most powerful and maybe most misunderstood creations in all of modern finance. So forget the scary headlines and the jargon for a minute. We're going to open up the toolbox and see how these things are actually built and what they're used for.
You know, the best way to think about all this stuff is to see it as a set of highly specialized tools. Seriously. Just like a regular engineer has wrenches and lasers and blueprints, a financial engineer has a toolkit for building custom solutions to really specific financial problems.
And like any good engineer, we gotta start with the basics. These are the fundamental building blocks, the hammers and screwdrivers of the financial world, that pretty much everything else is built on top of.
First tool up, options. Now, the absolute key thing to remember is that they give you the right to do something, but not the obligation. That's huge. A call option is basically a bet that a price is going up. It lets you lock in a buying price now. A put option? It's the exact opposite. A bet the price is going down, letting you lock in a selling price. Sounds simple, right? Well, how these options actually behave is where things get really fascinating.
To really get your head around options, it helps to think like a physicist. Seriously, their behavior is governed by these invisible forces that traders call the Greeks. Delta, that's the option's speed, how fast its price moves. Gamma is its acceleration. Theta is like a ticking clock. The option's value literally melts away over time. They call it time decay. And Vega, that measures how the option reacts to market turbulence or volatility. These aren't just abstract numbers. They are the laws of physics for this little financial universe.
Okay, let's grab the next tool in our basic kit, the interest rate swap. I know, the name sounds super complex, but the idea behind it is actually pretty simple. Imagine you've got a loan with a variable interest rate, but you just hate the uncertainty of it. Your friend, meanwhile, has a fixed-rate loan but thinks rates are about to go down and wishes they had a variable one. Well, a swap lets you two literally trade your interest payments without ever having to change your original loans.
So here's how that plays out in the real world. Company A wants stability. Company B wants to take a chance on falling rates. Through the swap, they just exchange the interest payment streams. So Company A now has a predictable fixed cost, and Company B gets the floating rate it was hoping for. Each one gets exactly what it needs, and it's all based on a notional amount of money, a theoretical number that's used for the math, but the principle itself never actually changes hands. It's a really powerful way to completely transform the nature of your debt.
Okay, so with the basics down, now we can get into the really creative side of financial engineering. These are the custom-built, super specialized tools that are often called exotic options. And they're designed to solve very specific, often one-of-a-kind, problems that the basic tools just can't handle.
First up is the look-back option. This thing is the ultimate no-regrets tool. I mean, imagine being able to look back over the last 3 months and buy a stock at its absolute rock-bottom lowest price during that whole period. That's exactly what a look-back call option lets you do. It's an incredible way to guarantee perfect timing. But, as you can probably imagine, that kind of power comes with a pretty hefty price tag.
Next, we've got the barrier option, which is basically an on-off switch. This option only springs into existence or gets wiped out if the price of the asset it's tied to hits a specific level or a barrier. So, for example, a knock-in call option might not even exist until a stock price climbs to, say, $110. It's a way to pay for protection, but only for scenarios you think could actually happen.
And finally, we've got the Asian option. And no, it has nothing to do with geography. This is the average price tool. Instead of its value being tied to the price on one specific day, its payoff depends on the average price over a whole period of time. This is incredibly useful for companies that need to protect themselves from price swings over weeks or months, because it smooths out all the crazy ups and downs of the market.
All right, let's shift gears and look at how these building blocks can create something truly profound, a way to trade a risk that you can't even see. I'm talking about the risk that a company, or even an entire country, might fail to pay back its debt. This is called credit risk, and financial engineers built a tool specifically to buy and sell it.
And that tool is the Credit Default Swap, or CDS. The easiest way to think of it is as an insurance policy. Let's say you own a company's bond, and you're worried they might go bankrupt and not pay you back. You can go out and buy a CDS. If that company defaults, the seller of the CDS pays you for your loss. This ability to just separate the credit risk from a bond and hand it off to someone else became one of the most powerful and, controversial forces in all of modern finance.
So let's just walk through the transaction. On one side, you have the protection buyer. They're paying a regular fee, kind of like an insurance premium. On the other side is the protection seller, who collects that fee in exchange for taking on the risk. And right in the middle is the reference entity. That's the company whose potential default is what the contract is all about. If that credit event actually happens, the seller pays up. And just like that, risk gets transferred clear across the financial system.
So now you have this massive, complex toolkit. You've got options, swaps, credit derivatives all interacting with each other. This creates a huge problem for any large bank or investment fund. With all these moving parts, how do you even begin to measure your total risk? How do you answer the CEO's simple and, frankly, terrifying question, how bad can it get? To answer that question, they came up with another tool called Value at Risk, or VAR. So, you pick a time frame, let's say 10 days, and you pick a confidence level, let's say 99%. The VAR model then tries to answer this question. What's the absolute maximum loss we should expect to see over that period, with 99% confidence? It's a way to try and boil down an entire ocean of complexity into a single understandable number.
And this is the result. After running these massive simulations on a portfolio, the output is just a single dollar amount. For this specific bond portfolio from our source material, the VAR is $11,946. So what does that actually mean? It means there's a 99% chance this portfolio won't lose more than that amount over the next 10 days. It's a snapshot, a probabilistic guess at your worst-case scenario.
So as we've seen, this toolkit is unbelievably powerful. These instruments let people manage risk with incredible precision, they let companies hedge against uncertainty, and they let investors build all kinds of specific strategies. But, and this is a big one, that same power is exactly what makes them so dangerous if they're ever misused or misunderstood. So what's the big picture here? Well, we've seen that modern finance is a world of some pretty incredible engineering. It's a system where basic tools like options are the Lego bricks for exotic, custom-built solutions. A world where even invisible risks, like a company defaulting, can be packaged up and sold. And where these super complex models try to boil it all down to one number that answers one simple question: how bad can it get?
And that really leaves us with this central question of modern finance, one that regulators and bankers are still grappling with every single day. We have built these unbelievably powerful tools, and they're capable of both creating stability and triggering a total collapse. The question we all have to think about is, how do we make sure they're used to build a stronger financial system and not to tear it all down?